Hello, and welcome to the webinar, 7 Strategies to Reduce Payroll Tax. My name is Eric Wallace with Argyle, and it's great to have everyone joining us today. I have a few administrative details to share with you, then we'll dig into our discussion. First, we'd like to thank Experian Employer Services for their partnership with today's event. They've been wonderful thought leadership partners to Argyle, and they're committed to providing you with valuable content and a great overall experience. Thank you again to Experian Employer Services. We appreciate you joining us today. We welcome you to stay socially connected during today's event. For those of you who are active on social media, please use the hashtag ArgyleDigital and follow us at Argyle Exec Forum. Also be sure to follow Argyle on LinkedIn for special announcements. I also wanted to take a moment to touch on our content neutrality policy, which we've curated based on the feedback we've received over the years from our members. Argyle is very proud and protective of this policy, as it reflects our commitment to ensure the neutrality and overall value of the content presented at our events. We've worked closely with our speaking faculty to ensure that you receive a set of balanced and neutral viewpoints during the session today, and we appreciate our member support of this policy. Finally, and most importantly, please submit all questions that come up during today's event into the chat section of the interface. Before we start, we'll have our speakers introduce themselves, and then we'll begin our discussion. Joe, let's begin with you.
Thank you, Eric. Good morning or good afternoon to our audience, depending on what part of the country you're joining us from today. My name is Joe Grimes. I am Director of Employment Taxes at Experian Employer Services, and I'm joined today by my colleague, Michael Orton, who is the Managing Director in our group. We both join you from Utah. I was maybe crazy enough to relocate my family from Phoenix, Arizona, up to the Salt Lake City area this year, and Michael is down in Southern Utah. And we're appreciative of you joining our webinar and look forward to this presentation today. So just starting with a quick introduction regarding our business unit, Experian Employer Services. We offer a range of bundled services that cover employment all the way from the onboarding of new employees to the termination or offboarding of employees. Our services cover the whole gamut. Today, our focus will be on employment tax, which, as you would see on this wheel, is just past 12 o'clock. Here are some of the statistics about our business unit. A couple ones that I wanted to call out. We have over 30 million employees that are covered by the services that we provide, which fall into over 3,000 clients of ours. We have helped our clients secure over $2 billion in tax incentives. We have screened over 10 million WOTC applications. And we also have reviewed and protested, where applicable, over 1 million unemployment claims. Proud of the work that we are doing at Experian. So jumping into our topic for today, Michael and I, our entire careers have been focused on consulting around employment taxes. And throughout our experience, we have found that oftentimes payroll tax takes a backseat to other tax types and oftentimes does not gather the attention or the focus that we believe is deserved. Statistically, a significant portion of both federal and state revenue is actually generated by payroll taxes. And as a result, we believe that payroll tax warrants a greater amount of strategic planning and consideration. Payroll tax is also unique because it's an above the line expense. And so any savings that we can achieve in payroll tax will actually boost EBITDA and can be hugely beneficial to an organization. Finally, wanted to just point out that many of the topics that we discussed today actually straddle both a multitude of business units. So we believe that coordination between payroll, HR, finance, and tax teams is critical in order to achieve the results that we're looking for. And with that, we have our first poll question.
So our first poll question is, who is responsible for helping your organization to streamline payroll tax processes and decrease payroll tax costs? And the way you can fill in polls is there on the right-hand side of your screen right next to chat. There's a tab for polls. So your options are internal tax experts, outside consultants, a combo of internal and external resources, or no one at the moment. And it looks like the majority of answers are a combo of internal and external resources. That's 60%. To you guys.
Thanks, Eric.
Thanks.
So I would say no surprise on that poll result, and that's the answer that we are hoping for. Michael and I, we've seen it all in our experience, everything from organizations that entirely outsource any payroll or payroll tax responsibilities. We have seen organizations that try and do it all themselves. And we're excited to see that most of you have reported a combination of both internal and external resources. That's great. All right, so here's our agenda today. As the title of our presentation indicated, we are going to talk about 7 different strategies to reduce payroll tax. The 7 are outlined here. We'll start with state unemployment optimization, then talk about merger and acquisition optimization. Third will be payroll process optimization. Fourth, fringe benefit optimization. Then 5th is health plan dependent verifications. 6th is vendor optimization, and rounding things out, number 7, improving notice resolution process. All right, so then with that, we'll jump into our first strategy, which is in relation to state unemployment, also known as SUI taxes. Here, it's important to note that SUI tax is actually unique in the sense that it's a controllable tax rate. Many tax rates are static or fixed, where here the employer and its actions actually can have a significant impact. And so we highly recommend benchmarking on a regular basis to make sure that your organization's SUI tax rates are in line with or beating the average. The US Department of Labor actually produces a report every year that includes the average state unemployment tax rate broken out by state. It's really easy to compare your tax rates to those of the averages across the United States. Additionally, we think it's important to know where you stand among your peers. And so comparing your rates to the averages of those in your industry is also important. And most unemployment claims providers have this data available and can help you to do that benchmarking against your peers if you desire.
Yeah, just to add, Joe, I think it's important to note you can achieve significant savings through tax rate reductions. So the purpose of that benchmarking is to simply say, where am I at? How am I performing against my peers? And if I'm not performing as well as hoped, what changes, what process changes can I make to improve process and as a result, reduce rates? And when you reduce rates, you reduce costs. And deploying this type of thoughtful or an intentional strategy can generate significant savings. The second one that we wanted to talk about in this SUI optimization is statutory elections. In general, statutory elections are made up of both voluntary contributions, which we'll talk about, and joint accounts. So the way that I like to think about voluntary contributions, it's actually you're given an opportunity in several states, roughly 50% of states allow this, to buy down your rate. Make a one-time payment now to reduce your rate in the subsequent year. Okay, and this can be extremely beneficial at certain times. A few things to call out. Number one, you need to improve models. Historically, models are very basic and very, very elementary to actually project what we think the savings will be. But one thing I can promise you, if you have variable headcount or changing headcount, whether it's increasing or decreasing, you need to build out more sophisticated models to project what you think that the savings will be in the subsequent year. And so it's important to not only try to capture these benefits, but to build out sophisticated models so you know what savings you can expect in the subsequent year. And in general, the way to think about this is if you have an increasing headcount, the savings will usually be enhanced or magnified compared to what the standard models will tell you. However, if you have a decreasing headcount, it will be the opposite. The standard models will overstate the savings that you can achieve. The other interesting thing that we're finding right now with regards to voluntary contributions is sometimes we think about this, and the way we think about this is oversimplified, meaning we simply ask ourselves, what do we have to pay now, and how does that payment compare to the savings that I expect next year? And if it's cash flow positive, we think, okay, well, let's pursue it. And if it's cash flow negative, we typically don't pursue. But in truth, things aren't always what they seem in this realm. For example, we're working with a lot of private equity firms, right? And private equity firms, they know that any dollar savings in EBITDA that we can secure will enhance the total enterprise value when they ultimately sell the target company. And so in these situations, they may even take a rate buy down where you have to pay $1 now to only generate 20 cents of savings next year. But knowing that they're going to sell this at a multiple of 10 down the road, they might even still be interested in making that buy down. And so I think we need to break free from this simplistic model just to look at a 1-year cash benefit in certain situations. Because like Joe said, this is a way to improve or increase EBITDA. And that can have an impact on purchase price, sell price, bank covenants, stock price. There can be a lot rolled into that. And so companies should be more strategic in how they are approaching this. The other statutory election that's important is joint accounts. It doesn't get quite as much attention as voluntary contributions, but the idea is if you have multiple subsidiaries in the same state, some states allow you to join those and treat it as one for tax rate purposes. So you might have a few high-rated entities and you might have a few low-rated entities, and when you bring them together, it can generate significant savings as a combined rated entity as opposed to separate subsidiaries. So this is a really easy way for you to generate savings, can be significant savings, and can be multi-year savings if you're strategic in the way you do it. So Joe, back to you.
Thanks, Michael. The workforce is becoming increasingly more mobile, and as a result, there's an impact in payroll taxes. Many of you may be aware that for income tax withholding, the general rule is that the taxes must be sourced to the state in which the services are provided. And obviously with a mobile workforce, that can result in income taxes being sourced to multiple states. However, SUI taxes are different. It is designed to actually only be sourced to a single state. And this can become problematic because the rules of allowing an organization to source SUI to a single state for each employee oftentimes does not mesh well with the actual payroll system. So there's a conflict between the rules that are allowed and the system capabilities, where oftentimes state unemployment tax sourcing and state income tax sourcing are tethered together in the payroll system. And when an employee moves or transfers from one state to another, we are seeing oftentimes that the SUI taxes restart and are sourced to the new state. And oftentimes this is not required. And so paying attention to your SUI sourcing and identifying situations in which employees may have SUI taxes being reported to multiple states can be a problem that is increasing your overall SUI tax cost, and something that can be resolved to help bring that SUI tax cost down.
Yeah, I love this one. This one really, I get excited when I talk about it. Where we're finding this happen most often is in industries where your labor travels state to state on a temporary basis. Think construction. We see it a lot in the construction world, where you have a Texas-based crew that takes temporary assignments in various different states throughout the year. And when that happens, you look back and you realize, wow, I paid state unemployment, erroneously or inadvertently, I paid payroll tax in each of those states. And going back, realizing that, and making sure that you're implementing that four-factor sourcing to a single state and avoiding the double payments that come can generate significant savings. We have a client now we're helping. This issue is definitely a seven-figure issue a year. And so helping them understand that, do the analysis, and treat it properly going forward is achieving significant above the line savings on an annual basis. The next one, it's similar. It's what we call a multi-state credit. So like Joe said, the rules are that you should really only be sourcing to a single state. That's how the rules work, unless there are a few scenarios that might break that assumption. And one would be when you actually physically move, when your base of operations moves from one state to another. And if that's the case, it does break four-factor sourcing, and you might source to more than one state in a given year. However, the states offer multi-state credits. Okay, so whatever you paid into the first state, you can take credit for when you start paying into the second state. Now, the problem with this is it's really, really great in theory. It's really difficult from a payroll systems perspective. Not only that, it's really difficult for the states to process properly. So for even those entities or those clients of ours that are trying to do this right, sometimes the states aren't accepting it fully, at least on the first try. And so making sure that you understand these multi-state credits and that they're being reported properly to the states, and then that they're sticking with the state, that the state is accepting and allowing you to take credit for those multi-state credits, that is important, and it's an easy way to reduce payroll costs.
Great. So moving on. Oh, yeah, let me talk briefly about data, the power of data when it comes to SUI tax optimization. So this slide is essentially just a snapshot or a dashboard of ways that employers can see the savings that they are gaining by optimizing their SUI taxes, right? So being able to use the data that you have to analyze your SUI tax cost per employee. That would be an easy way to track from year to year the overall tax cost, and to confirm by a payroll team that they're actually providing savings in this realm. So just wanted to reiterate the power of data and analytics when it comes to SUI taxes and employee wages, and the savings that can be validated by using that data in the right way. All right, Eric, back to you for the second poll question.
All right, the second poll question is, how likely is your organization to conduct a merger or acquisition over the next 18 months? Are you very likely, somewhat likely, not at all likely, or not privy, or not given advance notice? Majority of answers right now are not at all likely.
Yeah, as we're watching some of the responses come in here, thank you for answering these polls and providing us some insights. We saw an interesting but not surprising pause in merger and acquisition activity during the pandemic. But since then, M&A activity has been on the up and up. And so the initial results that I saw here were quite a few responses that were very likely, and then an equal number of responses that were not at all likely. So organizations tend to be either in one bucket or the other in terms of their organic growth versus growing through mergers and acquisitions. As you can guess, though, that leads us to our second strategy, which is optimizing payroll taxes during a merger or acquisition. Obviously, the merger and acquisition rules are complicated, and that results in there being opportunities both for savings and for pitfalls. And those opportunities vary by state. And so a one-size-fits-all approach in regards to merger and acquisition activity generally is going to result in higher payroll taxes, and that's not what we're looking for. Whereas with the right strategy, payroll taxes can be reduced and optimized during mergers and acquisitions when the facts of the transaction line up. And so that's where we actually spend a significant amount of time, is helping our clients through the complexity of mergers and acquisitions and the impact that it has on their payroll taxes. The assignment of being a successor employer does not happen automatically, but it can be highly beneficial. And as a result, it's something that a payroll tax team, in assistance from other business units within the organization, need to be considering carefully. We are also running into situations where a transaction is structured in a way by legal that would try to avoid a successor position. But oftentimes what legal or other business units don't understand is that the state rules for successorship generally have a lower threshold and can be triggered quite easily. In fact, the mere transfer of a workforce to a new legal entity in some states and some situations can be sufficient to trigger successor employer status, even if the organization is not intending to be a successor as part of a particular transaction. And when this is not considered, it can oftentimes result in higher payroll taxes being paid. But when it is considered, it can be highly beneficial to the organization. And I'll demonstrate on the next slide the savings that can be had when payroll taxes are thought about strategically in M&A. And again, here wanting to point out that savings that are resulted as a result of mergers and acquisitions, payroll tax savings are above the line and are going to strengthen EBITDA. So here's an example of a merger or an acquisition where employee is transferring to a new reporting entity for payroll purposes as a result of that transaction. The top table is an example of a highly compensated employee, and the bottom example would be an average compensation level. The three primary tax types that need to be factored in an acquisition are: number one, Social Security taxes, oftentimes referred to as FICA. Second is federal unemployment tax, oftentimes referred to as FUTA. And third is state unemployment tax, which we've been referring to as SUI. As you'll see, the major difference between these two examples that we've laid out is the FICA tax, where in a highly compensated environment, the FICA tax savings that can be had as a result of claiming successor employer status are significant. So in this example here, the situation would be that the employee had most of their FICA taxes covered prior to the acquisition. When that employee is transferred as part of the acquisition, if the organization does not implement successor rules and take credit for those prior taxes paid, they would basically repay that full amount of FICA tax. Whereas if an employer properly claims successor employer status, in this situation, we're showing that the FICA tax savings are nearly $4,000. And then obviously you also have savings that can be had with federal unemployment tax, which is a lower tax amount, and state unemployment tax, which is a lower tax amount. But oftentimes those taxes would have been fully satisfied by the predecessor in a transaction. And your organization, if you can properly claim successor status, would not have to repay those taxes at all again for those employees. So here we're demonstrating a single employee, but you can imagine what the results would be if there were hundreds or even thousands of employees that are transferred as part of an acquisition and how significant those savings can be.
Yeah, I think worth adding, Joe, we talk to a lot of employers, we talk to a lot of clients. The reality is 9 out of 10 times when we talk to someone after an acquisition, there's something here that was missed with regard to successorship. Whether it's this wage duplication that Joe has shown you, or whether it relates to the tax rates and inheriting the tax rates at the old co, there's usually opportunities that were not captured or were overlooked. And so it's important, anyone who has gone through acquisitions, is going through an acquisition, or you think will go through acquisitions, to think about these issues more strategically. Good news, if you had gone through an acquisition and this wasn't all considered fully, it's likely that you can still recover the resulting overpayments to a certain degree. So you haven't missed the boat just yet, but it's important to act quickly so you do not blow any statutes that are upcoming. And the other thing is, I mean, we've helped. I can tell you lots of stories and lots of examples of clients we've helped in this realm. And the truth is, there's always a correlation between value and benefit and the number of employees being acquired. Obviously, that's the number one driver, but it is not uncommon for these benefits to be 7 figures plus. I've even seen them break into the 8-figure range when the acquisition is large enough. And so it is something, again, keep reminding you, it's above the line. It generates additional EBITDA. Some of these savings can be multi-year, very lucrative. It's something to consider anytime there's an acquisition.
And just wanted to note that we are obviously very sympathetic to payroll teams that are having to deal with these complicated rules in an acquisition, especially because oftentimes the payroll teams are the last to know when some of these transactions are mapped out or executed. So to the extent that the payroll team can be included in the discussions earlier on, that can be hugely beneficial. But obviously, Michael, as you said, some of these transactions happen so quickly and are so complicated that these factors oftentimes just cannot be fully considered at the time of the transaction. And so there is that option to go back and recover refunds for these types of payroll taxes after the fact as well. All right, Michael, moving on to our third strategy.
And so this one's kind of a catch-all. It's a big bucket. We call it payroll process optimization. And this is essentially tightening the screws, avoiding mistakes that can be costly. I have a few thoughts, few stories to tell in this section. first one that's interesting that we find quite often relates to gross ups. That's a 4-letter word. Most payroll professionals, we don't like gross ups. They're complicated. And a gross up, for those who don't know, is when you typically give some sort of compensation, usually non-cash compensation, to an employee, and you want to pay the taxes, that the underlying taxes related to that compensation as well, so that they're whole. There's 2 ways to calculate that gross up. One is to use the standard W-4 rate method. So you're paying the tax they owe based on their W-4 rates. And the other is to use the supplemental flat rate. And the approach varies by client. But what I can promise you is oftentimes when we get in and we look at this and we analyze what's happening, what we realize is that when you calculate a gross up, you overpay, you pay more than their liability. So when you're trying to just make them whole, you're actually giving them a windfall. Okay. And so to be thoughtful about what is the situation, what is the type of employee, the class, the compensation level of this employee, and what is the most proper way to calculate the gross up is important. And if you're in a large organization that does a lot of different gross ups, this can become very, very, very meaningful. A quick story on this one. There are many companies that have a standard or routine spot bonus program where they give gift cards. And it's very common when giving a gift card to gross up. And the reason you'd want to gross up is if you don't gross up, you're actually reducing their net pay. Even though you're giving them a gift card, you're reducing their net pay and their paycheck to cover the taxes. And so it's common to gross up. And so there are companies that give thousands of gift cards a month. And if they're not strategic and thoughtful in how to gross up and doing it in the optimal way, that can result in hundreds of thousands of dollars of extra cost, extra windfall to their clients on an annual basis. And so thinking about this and slowing down and being thoughtful with those gross ups is important. Second thing, earning and deduction code setups. Joe and I, we've spent a lot of our career cleaning up mistakes, fixing problems. And some of the largest refund opportunities or cleanup opportunities that we've been part of is when someone sets up an earnings code incorrectly. You set it up as taxable when it could have been non-taxable. And when it sticks that way for years and years and years, the excess tax you pay accumulates and become very, very, very significant. And so we always say one of the easiest and best ways to reduce costs is to set up really clean controls when setting up new earning and deduction codes. Also, we think it's smart every 2-3 years to do just an overall review of the codes. This is even more important when you're an organization that makes several acquisitions. So you might start as one legal entity and one payroll team that's pretty clean and pretty simple. But after 10 years of acquisitions, you might open your eyes and have 10 different reporting entities. And some of them are operating more as a conglomerate than anything else because they all have the independent payroll teams and processes. And so to make sure that you standardize that is really important and avoid that costly mistake. The other thing we're seeing quite often is states are now transitioning or moving to more of an online platform. I'm sure you guys know this. It used to be that you reported to the state what your taxable wages were, and they accepted it at face value. That's your liability, and that is that. But as we move to more of a technical online platform, often what happens is that you report the taxable wages you think are due. The state will take the wages you report, mostly the gross wages or the SUI subject wages, and they will recalibrate what they think taxable wages should be. And that could be either lower or higher than what you thought it would be, right? And so what's happening, that and with COVID, there's been a lot of mid-year tax rate changes on the state unemployment side. And so what happens when you have these online platforms like this? Oftentimes they recalibrate things, they change things, and it generates credits that you're not aware of, and credits that they do not always advertise to you or make you aware of. And so I can't tell you how often we get involved and do a simple transcript scrub where we're talking to the states, where we're looking under rocks and asking questions, and we find what we call truncated credits, sometimes significant truncated credits. I think it's becoming such an issue with this technology, with this new technology, that we recommend you do this once every 3 years, just to make sure nothing is missed, nothing is overlooked. And you will be shocked at what can be found in those types of exercises. So that's our thought, just kind of an overall broad SUI process optimization, but I promise there's a lot there in terms of reducing payroll tax cost.
I just wanted to add, Michael, that even when our clients become aware of credits on the account, we're finding it increasingly difficult to actually get states to refund money. And so it just increases the amount of credits that are out there and available to be recovered with the right effort.
Yeah, for sure.
All right. And with that, we do have a notice resolution on this slide, but wanted to just call out that that one is important enough that we will be having our own slide at the end. It's a strategy on its own that we'll be discussing more. So with that, I think we're ready for our next poll question, number 3. Eric?
The next poll is, which fringe benefit do your employees value the most? Unfortunately, you can only pick one. There's cell phone reimbursement, tuition reimbursement, childcare reimbursement, use of a company vehicle, or a CAFE 125 plan, medical, vision, dental. Right now the answer is by far the healthcare one, the CAFE 125 plan.
Yeah, look at that.
That's great, Michael. That's setting you right up for the points that you'll make on the next slide. Give people just another couple seconds here to respond. Yeah, it looks like we're real close to 80% here on the CAFE 125 plan.
Okay, let's talk fringe benefit optimization. Again, this one, I get excited when we talk about this one. I think this is often overlooked and underutilized. The idea here is, we all know in general, fringe benefits are taxable. It's just another form of compensation subject to tax. However, there are fringe benefits that are tax-free, right? So there are specific call-outs, both on a federal and state level, certain fringe benefits that are tax-free. Now, the important thing, I think for this conversation, I want to separate. I want to break this up into 2 different buckets. One is what I call employer-funded fringe benefits. Those fringe benefits that the employer actually pays for, it funds. And then you have employee-funded fringe benefits. This is typically your cafeteria 125 plans, right? It's the employee simply chooses to allocate some of their paycheck to cover a fringe benefit. Let's first talk about employer-funded, those that the employer pays for. No, the reality is, a tax, this can be a significant benefit to employers, right? A tax-free fringe benefit is always beneficial. A few examples of tax-free fringe benefits: achievement awards. I see those used quite often. Educational assistance, there are caps and limits, but it can be there. Meals, oftentimes, maybe not often, but sometimes can be tax-free as well. Cell phone reimbursements or stipends, that's another big, really popular one. These are examples of tax-free fringe benefits that the employer pays for. Now, one caution here: a tax benefit that the employer pays for, in truth, yes, it's beneficial. But it's important to understand that if the employer is paying for the benefit, the tax savings, really, if you spend $1, it's only going to save you 10 cents, right? You're having to spend money to generate just a little bit of savings. So anyone when you currently don't offer these fringe benefits, don't run in thinking, oh, I'm going to offer this new amazing employer-funded fringe benefit is going to generate savings for me. That's not true. It's still going to be a significant net cost. However, I think it's important if you are an employer that already offers fringe benefits. Things are changing. Things are in constant flux in the payroll world, especially if you look at both states and federal rules. I think it's really important once every 3 years, once every 5 years, to kind of take inventory and simply ask, what fringe benefits am I offering, employer funded? And is there any way that I can swap a taxable for a non-taxable? And if it's $1 you're already spending and you're just swapping taxable to non-taxable, that 10-cent savings can be significant, right? It can add up. So it's important to remember that. Another example that I see, there are certain employers that simply say, hey, we're having retention issues or employee morale issues, and we need to do something. We need to offer another benefit to help. So that's $1 you're going to spend anyway. And if that's your situation, you're always going to want to gravitate towards those tax-free benefits where possible, as long as you think it's still going to be meaningful to the employee. One tax benefit that I think should be easy, it should be obvious to everyone, is cell phone reimbursements. The IRS, they've really eased the requirements of what qualifies for cell phone reimbursement. In most cases, it is tax-free. And you can not only do a reimbursement now, but you can do a stipend. And so you can just include, maybe even in lieu of a raise this year, you say, I'm not going to give you, 5% raise, maybe it's only 3%, but I'm going to add in cell phone reimbursement. All you're doing is giving them cash that is considered tax-free. It's a really, really easy strategy to deploy to secure some savings. So that's the employer-funded bucket. The one that I think is more interesting is the employee-funded bucket. This is a situation where the employee simply decides to take part of their paycheck and allocate it towards a benefit of their choice. This is, like I said, your cafeteria 125 plan. A few examples: health insurance, dependent care, HSA. The amazing thing about this one is that the employer does not go out of pocket. If your employee decides to allocate some of their hard-earned money to a tax-free fringe benefit that they fund, that obviously reduces their tax basis, reduces their tax costs, can be extremely beneficial to the employee, but guess what? It reduces yours as well as the employer. So now you have a zero-cost tax reduction. A few examples of how this works. One, dependent care. I love dependent care. I think it's really, really underutilized out there. But you have a lot of employees who require childcare. And if they knew that they could secure 30% savings, up to 30% savings, simply by using one of these dependent care assistance programs, they would probably do it. And if they allocate their funds there, not only does it help them and reduce their costs and improve their cash flow, it's going to help you as well. The other one that I love is HSA. HSA is amazing, right? Same thing. Your employee decides to allocate some of their money to HSA. There's a double benefit with HSA though, because not only does it reduce their tax basis and your tax basis and generate tax savings, but you only qualify for HSA if you're in a low-cost plan. So there's a double savings there to the employer. So much so that we're starting to see more and more employers offering to contribute some money to an HSA, an employer contribution, because it encourages employees to participate in HSA, and they know that even though they're having to contribute something to incentivize, it's still generating a net savings. So to me, these are no-brainers for employers. It's a strategy that you should always consider and think about. And the two steps in my mind are: one, let's make sure we make these types of employee-funded benefits available. Look at your cafeteria plans, see if you can expand and offer some of these employee-funded benefits, because it's only going to reduce your tax cost. Second, in addition to making them available, I think education is important here. I'm going to admit something that's maybe somewhat embarrassing. I am a payroll tax professional. I've spent my entire life in payroll tax. And I didn't participate in a simple HSA plan for probably 10 years. It took me 10 years to figure out how beneficial that could be. And it was just maybe a little laziness and a little bit of lack of education and a little bit of ignorance. And it was a little bit difficult to check the right boxes in annual enrollment. And I missed out on that benefit. Knowing that it not only helps your employees, but it actually helps the employer, I wonder how much benefit can be secured by actually advertising and educating and help people understanding these choices. So when they make the right choice, which it is obvious with HSAs, independent care, it helps reduce your cost. So we're seeing employers being more strategic and, like I said, intentional and thoughtful in their approach as a way to reduce tax costs and boost EBITDA.
Right on. And moving into our fifth strategy, which is a health plan dependent verification. Studies are showing that between 3 and 15% of the individuals that are enrolled in health plans are not actually eligible. And at risk of stating the obvious, by employers contributing to the costs of these health plans and covering individuals that are not eligible, the employer's paying more than they need to, and then they should be paying. So there's a couple ways to approach this. One way would be to conduct an audit of your dependents to verify that those who are participating are actually eligible. As you can imagine, conducting a health plan audit would be quite a touchy subject with many employees. And so we recommend being very careful in how it's messaged, and the studies actually show that this is rarely a situation where there's intentional disregard of the rules, and more so it is employees that were unaware of the eligibility rules, or there was some miscommunication. And so, and the examples that we have listed out here, I believe help support that this is oftentimes more an accident than it is intentional. So the examples here of participants that may be ineligible and still participating in your health plan would be children that have reached the maximum age limit. So they have aged out and are no longer eligible to participate, but are still on the plan. Another example are divorced spouses. Another example in the same vein would be children who are impacted by a change in custody arrangements, and then other misunderstandings. So again, an audit of your health plan may result in reducing the number of participants and therefore the amount of contributions that employers are making to that plan, but tread lightly if your approach is an audit. The second way to save in regards to health plan dependence is to increase the documentation requirements and the review of such documentations during plan enrollment. So instead of just simply relying on employees to enroll the correct individuals, reviewing them during that time is a way to help make sure that ineligible individuals are left off the plan, and therefore decreasing the costs that employers are experiencing. Additionally, a benefit here is that by reviewing plan eligibility, it oftentimes will help increase your compliance with the actual plan eligibility rules. And so not only is there a cost savings, but there's a compliance benefit here as well. And this is an area, obviously, that straddles multiple business units. And so it may not be something that payroll is directly leading, but it's something that payroll can encourage with coordination with HR and other teams that are responsible for those health plans. And obviously, this has a huge impact on employees. Okay, moving to our sixth strategy.
And I know we're short on time. And so we'll move through these last ones rather quickly. Here is vendor optimization. And I know this is probably a little bit strange to have a vendor talking about vendor optimization, but I feel like we have to at least bring it up because it is a way to significantly reduce cost. I have three thoughts with regards to vendor optimization. Number one, in this world, because of technology advancements and efficiencies, in many areas, we're actually seeing costs reduce over time. That shouldn't come as a surprise. And so oftentimes, your vendors, the most lucrative contracts they have are the oldest contracts they have. And so it is always a good idea to be proactive in discussing contract terms. Just the reality of the situation. I do this all the time with my cell phone carrier. I always laugh because once every 2 years, when I have a reason to call them, I ask, hey, let's look at my plan. Is there any way, am I overpaying in any way? Is there any way to reduce my cost? And I think I've reduced costs five for five over the last 10 years when I call, and it's exactly what's happening, right? The cost of cell phones are actually reducing. And so you're usually, by asking that question, you're getting some sort of savings along the way. I think it's the same for you as an employer. Always be mindful of that. Secondly, consolidate vendors. You're going to see this a lot. Consolidating vendors will benefit you in three ways, in my opinion. Number one is cost. The more a vendor has to offer, the more services you bundle together, the deeper you get into bulk discounts. It's very real, and it's an easy way for you to reduce costs. Not only that, though, but when you talk about data feeds and contacts and efficiency and time that you have to deploy working with your vendor, you not only have an actual hard reduction of cost, but you have some efficiencies you gain over time for sure. So I would always keep that in mind and strive where possible to consolidate. And lastly, consolidate reporting entities. This is one we see all the time. People don't realize that many vendors, one of the components used to determine pricing is simply how many different EINs report payroll. And if you look at what's happened over the last 50 years, the number of reporting entities for a typical organization has grown exponentially. And that's because attorneys got involved. They want to isolate liability or separate divisions into different legal entities, or you may have acquired companies along the way, or you might have set up something like a shared service center and you're consolidating functions. There's a lot of different reasons as to why you went from 1 to 85 reporting entities, but many organizations did. And so often it's important to look at that through the lens of payroll vendor costs. And sometimes there's some cleanup and some entity rationalization, or asking them to look at this a little bit differently that will secure savings. So consolidating reporting where possible can generate significant cost reductions as well.
And with that, we'll move to our fourth and final polling question. Eric?
So our last poll question is, approximately how many notices does your organization receive from tax agencies on a monthly basis? Less than 25, between 25 and 75, or over 75? And
Okay.
right now it looks like the majority is less than 25.
Yeah, that's good. So our final slide here and our final strategy for reducing payroll tax costs is actually to improve notice resolution process. So glad that so many of you are not being overly burdened with tax notices. Obviously, even 25 in a month is still something that's going to take some time and effort. Being short on time here, our key points is that by improving your notice resolution process, you can decrease the leakage that is occurring with payroll taxes and therefore decrease the tax costs that are being expended. State agencies are constantly making mistakes when in regards to the notices that they're generating, and so the clients that we are helping that may have previously just assumed that whatever notice they were getting just needed to be paid to try and make it go away, that's allowing for leakage and increased costs. And so by putting some attention and effort into an actual resolution process, a lot of savings can be had, and including decreasing penalties and interest and state unemployment penalty rates, which add up very quickly. And then final point here is how critical the state the state online portals are becoming in order to properly manage your payroll tax account in each jurisdiction. So we highly recommend utilizing those online accounts.
Yeah, I love this. Leakage it's a big problem in payroll tax. We help clients with this constantly. And when we do, we typically track a metric that's called liability avoided, right? So when you assign us a notice to us and we help you resolve that notice, what is the actual liability assessment that we're avoiding, or the penalties that we're reducing? And it's quite surprising, especially for large organizations. When you sit back and you add up the liability that's avoided, it can be shocking. And so this is an important one. And I think with that, I want to round out here. The purpose of today's call was to talk about 7 ways to reduce payroll tax costs. Like Joe said, there are 2 main points. Number 1, payroll tax is above the line. Anyone in finance can tell you how beneficial and significant that is. So any dollar savings we can achieve can be meaningful. Number 2, payroll tax is often overlooked. It's often overlooked. Payroll teams are typically understaffed, and there's over-reliance on payroll vendors, thinking that they're constantly watching these and addressing these things for you, and in general, they are not. And 3, when thoughtful, with these 7 strategies we've discussed, we think these are really easy and meaningful ways to reduce your payroll tax spend. And we've seen, not only do we believe that, but we've seen it work time and time again, and we help clients through these issues quite often. I see some questions coming through. I'm sorry, we ran out of time. We don't have a chance to address all of them. Anyone who has questions, our contact information should be provided. If you guys want to discuss anything we've talked about today, we're happy to do so.
We have a general email address listed here on the slides, and I will also drop my direct email address into the chat today, so that some of these questions that were raised that we weren't able to address, we can feel free to reach out directly. We're happy to chat. And with that, Eric, we'll turn it back over to you to wrap it up.
Great. Thank you, Joe and Michael, for that amazing discussion. And thanks everyone in the audience for joining us today for this excellent webinar, and enjoy the rest of your day.